this is perfectly timed, really, as the officials really tried to crash the price of gold.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi there, my name is Shane Moran, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on this intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge, we'll bring you the understanding that the mainstream media just won't provide. Now, just before we head over to the UK, please help us by spreading the word about this channel. It really helps out the channel when you hit that like button. You can go ahead and do that now. Share this information and be sure to subscribe if you haven't already done so. And if you want to be notified in real time as each episode goes live, all you got to do is hit that bell right there and we'll do just that. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, as usual, we've got a ton of great subscriber questions. We're going to go through them here in a second, but we've got lots to cover here today. But can we start off by connecting the dots between our last episode? It seems so long ago, but it's only been 2 weeks, that market episode, and what you're seeing right now as we move into the end of May action.
Yes, Shane, that's really always a good place to start. So then we'll look at why it's inevitable that gold will, have to be to exceed a minimum consensus equilibrium price of $3,000, which will have to be which will actually be the next staging point for the next leg of a very large physically driven rally. Now, so first, let's drill down into the short-term action. And as you recall, when we recorded our last market update episode, that was 2 weeks ago, spot gold was trading at around about 23.50. And since then, we've evidenced a $100 rally to an all-time high of 24.50, swiftly followed by an officially driven 3-day $125 pullback from those highs back to around about 23.25, which then met very large, strong Asian dip buying, where we are pretty much as we record this episode with spot gold at very similar levels. Now, given this pullback was accompanied by another round of really planted mainstream media calls, expect a gold correction. We saw that everywhere. Suddenly people are rubbing their hands, mithering and saying, yeah, well, and you can't blame people, because historically, when we hit a new high, we usually then, really take a big hit. Why? Because it was the CTAs were on the long side of that. So really the most raised question to answer, which I was getting, is where are we seeing the balance between where the central bank physical support levels are, which I know that a cartel does not want to enter, and how much of the recent gold rally to all-time highs was in the hands of the easily rinsable hot money CTA paper longs. So let's kind of dig into that. And because Chinese buying has been largely driven the 3-month $450 rally per ounce rally, breakout rally, really, driving gold right out of the officially capped 2024 range that it had been contained in. In our last episode, we drilled down into the question, which was, is current Chinese driven gold buying speculative and vulnerable to a historic crash? And in summary, we reported that while we saw the paper market technically overbought at that time, which is why there was many, many calls and attempts to ignite this historical type of correction, bottom line, we had determined that there was simply not enough hot money, naked long CTAs, which these are the guys that have taken the COMEX casino chips. There wasn't enough of them to rinse out for the cartel to achieve its objective of igniting a crash so that they could actually square off very large, and I mean very large, extremely wrong-footed derivative bets that they had made against gold at the beginning of 2024, and they were betting it would stay under 2,000. So into this round trip, which was a two-way action where we evidenced fresh all-time record high. Bearing in mind these gold fixes are deliverable, followed by a paper gold flush back to almost exactly where we were trading 2 weeks ago on the 15th of May. And we're recording this on the 29th. What we've just witnessed is simply a two-way flush of 96% leveraged hot money, CTAs, naked longs, essentially. They only have 4% into the game, skin in the game. And they coattailed what was fundamentally a physically driven rally. So whereas one side is, the physically driven side is 100% funded, these guys were chasing speculative, holding just 4% of the value of those contracts. And it was the naked long supply that had provided the fuel for the cartel to flush them back out. But this is the important point. As the scope of this cartel selling was limited to getting back the casino chips that these momentum CTAs had borrowed from them, once squared, it neutralized any further sell ignition. This was actually another case of be careful what you ask for. These led by the nose momentums, who drive pretty much the bulk of all the COMEX driven 96% leveraged action, they don't like sideways action. So predictably, if they're not running long, they jump in short. They hate sideways action. And while the cartel took the long side of these leveraged naked short paper bets, so they were borrowing from the cartel to sell, and the cartel's on the long side of that, it nevertheless ended up backfiring on the cartel as we once again evidenced stealthy central bank bidders alchemizing COMEX-driven paper gold prices into physical, i.e. taking 96% leveraged bullion and forcing it to be physically squared. This is a bill that once again landed at the feet of the cartel, forcing the balance point for the next stair step to rally from. And after CTA driven, we have PCE on Friday, which is when this episode will be released. And there's going to be volatility into that. So we expect that because the CTAs will be led by the nose and we see every time there's a Fed speaker come on, suddenly everything looks bearish. Oh yeah, we're all hawkish now. Suddenly, there's some hope. I mean, it really is flip-flop Fed speak that is driving these guys and creating volatility, which the cartel actually quite loves. And while PCE is the Fed's watched inflationary measure, as far as central bank demand for physical gold is concerned, beat or miss, it's irrelevant in influencing this relentless central bank demand, which views gold far too cheap under $3,000 and a far less risky, more importantly, a far less risky first tier asset class versus US treasuries, which they're dumping. And these historical wash and rinse cycles are getting limited to the scope of how much of this paper gold the market making cartel can take the long or short side of before they expose themselves to predatory physical buyers who realize that these gifts are ultimately going to be arbitraged into a real, undiluted global physical price, which is going to be a hell of a lot higher than the capped diluted price. Now, that's been the game for well over 50 years, but since Basel III NSFR regulations revalued FX gold as a first-tier asset class, directly competing with treasuries, gold has been in strong on and off record central bank accumulations. And while it took 1 year and 3 months, essentially, to fracture the officially sanctioned cartels, LBMA, CME ring fence, in the future, there will be far fewer paper diluted discounts to capitalize on. So it's interesting. So really, we'll kind of draw attention to that. So let's look at the pullback and the opportunities it has presented, not just for us, but for relentless Chinese official and retail gold demand. And for this, we need to look at the wider picture as it provides us a much better understanding of why gold has to reach the next staging point at 3,000, a level which will force the Fed to revalue Treasury gold. It has to, alongside really writing some very big, freshly printed checks to buy back extremely underwater gold derivative bets that they've laid on the too big to fail agent bullion banks, which they will have to bail out, essentially.
Hey, Andrew, before we started recording today, you were expanding on what's driving China's appetite for gold. And this picks up from our last episode where the IMF relations you talked about. Can you please share this information with us?
Yes, Shane. Further to the IFM reporting China's ongoing de-dollarizing progress, which, remember, this used to be shunned by the media. Now this is mainstream now, which if you just as a reminder, what it had done is captured China visibly stepping up Treasury sales during the first quarter of this year in almost equal amounts to their gold purchases, more than doubling their gold FX reserves from under 2% in 2015 to 4.3% in 2023. Now, based upon reliable liquidity provider feedback, we currently see this official activity more than doubling, let alone what is unreported. Now, as we approach the end of the second quarter, we tasked our well-connected liquidity providers to provide us a best estimate of what they are seeing into this obvious swap of Chinese high counterparty risk, first-tier US Treasuries to purchase zero counterparty risk first-tier gold. That is the process. This is particularly of interest following the last 2 weeks of official gold interventions as they attempted to rescue their deeply underwater naked short options derivative bets coming due yesterday on Tuesday. Now, as we previously assessed, the bulk of these official PBOC gold purchases reported by the IMF have been added in 2023, but it was really the bulk of them came directly after FX gold was reclassified under Basel III NSFR protocol as an alternate first-tier asset class, opening up FX gold to directly compete with US Treasuries and related agency bonds. Now, as we've also assessed in our last episode, the swap of US Treasuries for gold had really ramped up 3 months ago in mid-February. That's kind of where the breakout point came, undoubtedly driving the $450 rally in gold, priced in dollars, that is. In the process, further disconnecting the historical inverse foreign exchange-related algo correlations following the peg breaking 2 years ago. So the peg broke 2 years ago, but we saw it step up in February, mid-February. Now, it's important to note that the IFM's first quarter assessment had only captured just 2 weeks of the period following Beijing stepping up gold buying on the 13th of February, which had been triggered after the Fed-led cartel misjudged the overrun of the CTAs selling through massive tonnage size central bank orders that had aggregated sub-spot 2000. Remember, we talked about that, them making a huge mistake there, that overrun. And basically the reason I raise it now, we've just drawn attention to a not too dissimilar overrun witnessed last week after the Fed's desperate options rescue attempts drove the same CTA momentum sellers through 2 waiting central bank tonnage orders at spot 2400 and then at 2350 into those 2 breaches, also tripping off very large exchange for physical outflows. Remember, an EFP outflow is simply what can be taken out of the COMEX and delivered into the NSFR compliant FX gold markets where it has to be delivered. So it removes that 96% leverage. And so basically, really, so far, this has evidenced massive tonnage size removed. And of course, what is being officially reported, it does not include the unreported exchange of billions of dollars of Chinese shadow bank FX reserve, facilitating an ongoing one-way journey of hundreds of tons of 400-ounce 995 monetary gold LBMA bars being melted into Chinese 4/9 kilo bars. Now, this activity has stepped up significantly following Yellen and Blinken's recent stick-waving sanction warning visits, directly resulting in a fresh round of US-led Chinese sanctions. Then we saw China retaliate by sanctioning another layer of US firms providing arms sales to Taiwan. But this thing is just getting out of kilter. And liquidity providers report this is when official gold buying also stepped up significantly over the last 2 weeks, perfectly timed with the officials. This is perfectly timed, really, as the officials really tried to crash the price of gold. So, yeah, not good for them at all, but it enabled them to actually buy it, to actually at least rinse out these CTAs. Now, I think Bloomberg's first quarter assessment was also reported that China had sold a record amount of Treasury and US agency bonds during the first quarter. Now, their analysis also highlighting Beijing's move to diversify, quote, out of American assets into increasingly weaponized sanction talk. Now, according to Bloomberg, Beijing had offloaded some 53.3 billion of US treasuries and agency bonds during the first quarter, which were clearly converted into gold. Now, notably, this end of first quarter data only captured the first $120 of the large physically driven ultimate $450 price ramp. Well, so far, into the first 8 weeks of this 13 weeks of the second quarter, gold had by last Monday risen an additional $250 higher into 2,450. And while the dollar price of gold was officially smacked down lower, in direct contrast, the SGE and Moscow premiums rose. And by the market close on Friday, which is last Friday, liquidity providers' best assessment was that Beijing had one-to-one swapped an additional 135 to 140 billion of US treasuries and agency bonds for first-tier gold. And with 5 weeks left to go into this week's gifted discount, selling of dollars for gold is expected to have risen dramatically. And we'll have more information about that over the next week. Now, the growing T+2 overhang, T+2 meaning that basically when this buying is effected in the foreign exchange markets, there has been an obligation to physically deliver first-tier gold, that is, first-tier asset class. In other words, it has to be fully backed to be a first-tier asset class, to deliver it within 2 days. And so the growing T+2 overhang of this relentless central bank demand hitting the LBMA benchmark gold fixes continues to weigh on officials trying to desperately to escape very large, wrong-footed options derivative bets. Now, in a moment, I'm going to look at the bullish implications of this week's T+1 forced delivery compliance. In other words, no longer 2 days to deliver, just 1. And that came into force yesterday on the May the 28th, which was, interestingly, their options deadline. Not looking good for these guys. And drilling down, the upside breach of the central bank buy stops at 2,400 marked an all-time high Asian-driven spot fix, and that was at 2,444.35. evidencing unwavering, this is an all-time high, unwavering PBOC and Saudi buying. Just they're buying into rises and dips. It's irrelevant to them. And while we had noted that the technically overbought conditions into last week's slew of 16 Fed speakers turned up, spinning their plates. And of course, that creates the obligatory algo-driven FOMC volatility alongside it. I mean, it would basically, it really served to expose some as unyet rinsed these CTA long momentum chasers who were still naked long. And so basically these momentum chasers, there was no surprise that the officials went after them because really they have no intention of ever taking delivery and they've only got 4% of skin in the game. Of course, they just bail quickly. So what do? Where would you do that? You would look, as an official, you would look at where's the 10-day moving average. Why? Because they always have their buy and sell stops at the 10-day moving average. How simple that game is. But the PBOC and Saudi buyers and the Russian buyers know this game and we're waiting with open arms. And that's what's been happening. And while officials succeeded in rinsing out every single non-sticky naked long CTA, and bear in mind that some of these CTAs are using gold as a first-year asset class. So basically, every single one of these non-sticky ones were rinsed out. And then they flipped them, because they want a direction, they flipped them naked short into the targeted breach of the 10-day moving average. And this generated momentum, ultimately breached the two major central bank bid levels, which was 2,400 and 2,350 spot. Now, liquidity providers assess that this aggressive Wednesday through Friday disconnect added to an already extremely large T+2 physical delivery overhang directly attributed to the PBOC demand. So they were connected. And on the hook to physically deliver, this will force officials to short cover into, but limited to the bandwidth of these sucked in CTA sellers. So only to the degree they've borrowed the chips that you can get back. Every single central bank knows that the hegemonic Fed is trapped into capping a rising gold price and are reading them and gaming them. Official defense of the extremely wrong-footed multi-billion-dollar option structure is just a case in point. And they know about this. And this short-term action feeds into the larger picture, really serving to shorten the gold price reset fuse. Now, with Western physical gold exiting the Fed's cartel control in such large size, it's forcing the unwind of hundreds of tons of 96% leveraged COMEX gold, not limited to the visible reported open interest exiting the back door of the COMEX EFP to be fully funded to meet T+2 NSFR compliance in London, but also providing central banks the ability to alchemize this diluted COMEX prices that directly influence the deliverable spot gold FX market fixes. So you don't even need to take it out of the COMEX. Simply their antics in the COMEX set the deliverable price. You couldn't make this stuff up. It is unbelievably easy to read. And the central banks want to accumulate gold and are simply, why would you not wait for these events as well?
Now, Andrew, you had mentioned the significance of the shortened T+1 gold delivery timelines. Can you expand on this?
Yes, this is really important. And I have not heard any of the news services or analysts discussing this. And this spike in the cartel COG comes on top of the physical price now being determined outside the cartel CME LBMA ring fence, which, as we determined for the first time in over 50 years, the Fed controlled market makers are forced to become price takers. Now, further unraveling their grip on the dollar price of gold rising, as of yesterday, recording this on Wednesday, the decade-old T+2 physical delivery window halved to T+1. Now, this is the last thing a wrong-footed cartel needs, as they have failed, and they failed to circumvent it as much as they tried to do. And unlike Western exchanges, who've been dragging their feet to tighten up widely abused T+2 gold and silver settlement cycles, and with silver, non-NSFR compliant, particularly silver, we'll look at that in a minute, Global South exchanges have long imposed T+1 settlement cycles because Chinese exchanges are physically settled. They've always required a standardized T+0 immediate settlement for stocks and a T+1 settlement cycle for cash and foreign exchange transactions. However, as far as foreign exchange gold and silver are concerned, and we're talking about a 10 times larger, a multi-trillion-dollar marketplace, much larger than the COMEX. As far as FX gold and silver is concerned, Basel III deadlines now force all the current non-compliant Western exchanges to comply with this T+1 global exchange settlement standard. So as to de-risk broker dealers' transactions and to comply with Basel III standards, on the first trading day of 2023, India immediately moved to T+1 settlement delivery conditions smart. 17 months later, dragged kicking and streaming to comply this week, as of yesterday on the 28th of May, the US, Canada, and Mexican broker dealers were forced to follow suit. Now, given that this shortened T+1 delivery timeline also touches the global foreign exchange markets, and that foreign exchange gold is classified as an SFR compliant, physically deliverable first-year asset class, the implications of this are extremely bullish. And this will be extremely bullish for non-NSFR compliant FX silver. Now, what is not factored in yet is while the UK and Europe are going to drag their feet to comply, tabling as late as 2027 to comply, as far as the LBMA market making bullion banks are concerned, because FX gold, spot gold and silver is crossed against the compliant US dollar, which does comply, it forces T+1 physical settlement compliance on FX gold and silver transactions. It's that simple. This is going to severely tighten up the old T+2 spot gold FX market delivery flywheel, making it far riskier for the Fed's agent banks to add undeliverable cash settled gold supply being called for next day delivery, essentially immediate delivery, outside their little containment fence. And this will also tighten up the current largely unregulated multi-billion dollar options foreign exchange structure reported in the Office of the Comptroller report. And we'll dig into that next time, because that is where literally trillions of derivative bets sit, and the COMEX positions just reflect them. Much, much larger. So really short term, as we look forward into the last month of the second quarter, which commences on June the 1st, the very strong physical demand that drove fresh all-time high AM and PM fixes last Monday is still there. It's still there. The subsequent official interventions were instigated to rescue simply these very large reported wrong-footed derivative bets against gold closing above 2,300 spot yesterday on Tuesday. They failed, and it is very rare. But this explains the blatantly obvious post-fix selling events we've been witnessing. So we've seen the fix being fixed, and then bang, suddenly the sellers come in. I mean, good Lord, if it isn't, it's so obvious, it's ridiculous. It shows a very weak hand, because if you have to wait until everyone clears for the day before you start smacking the gold price down in large size, and then guess what? Guess who picks it up in the morning? The Asian buyers. Thank you very much. And this has been the pattern that we've been seeing. And you'd think they would actually start to wise up. And of course, they're seeing it. But when you are trapped literally into a huge derivative. If derivatives outstanding in general are about $2 quadrillion, an inconceivably large number. They're all interrelated, and gold is a very large component of. And in other words, if you want one of those daisy chains to fall out, it'll be gold. And they're definitely trying to protect themselves. And it's not going unnoticed by the PBOC and Saudi and central banks buyers. As I say, being so obvious, this options defense has exposed a very weak, wrong-footed official hand.
All right, Andrew. Now, you were saying that it's not just the central bank buying or the central banks that are buying that's driving up the bullion demand. Can you elaborate on what you meant by that?
Yes, Shane. While it's no secret that the PBOC is on and off record accruing underpriced Western bullion, it leaves Chinese wholesalers undersupplied to fill very large Chinese retail jewelry and bar demand. This competing Chinese physical demand is driving the global price of physical bullion far higher than the COMEX-derived, synthetically diluted spot LBMA spot gold price. So what are you going to do? You're going to buy it. And this very lucrative arbitrage trade is evident by the consistent large premiums over spot evident in both the SGE and Moscow physical exchanges. And having tapped out all Chinese mine supply, Beijing has stepped up their at-market gold buying. Liquidity providers assess there will be no let-up in PBOC buying sub 3,000. And I'm not saying it's going to stop there. It is simply a bridge to, and along the way, a lot can happen here. And we'll deal with some of those questions later. I know we will. Now, given the too big to fail agent banks acting on their behalf don't have the bullion to deliver against a very large growing T+1 NSFR overhang triggered by the central bank buy triggers that were hit into those breaches of these identified spot bids at 2,400, 2,350. Those round numbers were where those bids were sitting and waiting. And looking ahead to this week's T+1 compliance as it rolls out, the Fed will have to print dollars to buy back these wrong-footed bets at higher prices. Now, much larger spot gold bets were estimated to be around, these are about 10 times larger than what is reflected in the more visible COMEX OPEX bets, which they were trying to force a close below 2,300. And as we discussed last episode, with China, Saudi, and Russia now settling the price for for deliverable physical gold, net of what can be offset against this declining volume of captive CTAs, the Western price diluted exchanges have ultimately become price takers. And we talked about that last time. So now that the coat-tailing, naked, long CTAs have been rinsed out, we now look at the scope of how many of these momentum-driven naked shorts can be sucked in to provide more official short cover. In other words, when they borrow gold to sell short into what they can't see as a physical, and if you're siloed in the COMEX, how would you know that there are physical central bank buyers there? You don't know. You're just following what the mainstream media says. So really, this is a foolish game. But the officials do know this, but they're just trying to max out as much cover as they can. Now, bearing in mind, while officials can print dollars to offset COMEX paper losses, they do not have the physical to deliver against NSFR compliant spot gold being bid for delivery. And this defensive options action will backfire once the obligatory algo-driven PCE volatility settles into human buyers next week. Now, when contrasted against the extremely large SGE and Moscow physical premiums and wholesale retail shortages in China at current prices, the last 2 weeks of anemic COMEX-influenced fixed action has exposed, as I say, a very weak, wrong-footed, short-fed hand.
And one of my favorites, Andrew, is what are you seeing in the silver markets?
Well, I figured that would come up, Shane. Well, aside from the fact that silver has obviously broken out of its cartel capped paper range, I think because silver is an FX cross against the compliant dollar side of that cross, the resultant T+1 silver FX settlement protocol will significantly shorten timelines for physical settlement and shine an unwanted light into the cartel's paper shuffling antics. T+2 gave you a lot of leeway. T+1 halves that. And this can only help at a time that physical silver demand is so strong into tight supply. Now, in gold, the same actors in silver reveal gold is coiling for the next leg up of a rally. So that's why we really watch silver closely, even when looking at gold. Silver is destined to tag its next staging point at $35.25. This is another major cartel inflection point, forcing a capitulative scramble to short cover, ultimately opening up an easy test of $50. And if you remember, this is the same kind of pivot point we said, watch out for 26,225. This was the pivot point for the breakout. And that's exactly what happened. This is the next pivot point that we're watching closely. Now, given the options sweet spot at $30 into yesterday's options derivative bets was squared $2 higher, that's $10,000 per contract higher, the last line of defense is starting to migrate to $35. With T+1 protocol being imposed on spot FX silver, we're going to really watch this very, very closely. This is potentially a huge opportunity. Silver has yet to do what gold has done, which is exceed its all-time highs. Now, while I think of it, just a quick note about the COMEX published COT reports, because I always get questions about that. Just very quickly, with so many traders, because there's so many traders rely on this to make decisions. Now, the market-making CME and member insiders have the up-to-date unpublished data at the end of each day. These deliberately delayed 3-day CME reports, and by the time we get the next one, a ludicrous 10 days stale, are designed to wrong foot as many participants as possible and always fail to capture the inevitable post-COT cutoff, which is always on a Tuesday, and then we always see the big action between a Wednesday to Friday. This by design. And connecting the dots to what we estimate now, currently every CTA long has been flushed out. As I say, this leaves CTA shorts to provide further short cover, but in my opinion, insufficient in scope to rescue the naked short officially held billions of dollars of further out underwater options bets. These bets are huge, but they're underwater. And there's no way that the physical buyers are going to sit back and let them cover. Payback will come into contract rollover volatility when liquidity providers report physical buyers are just simply going to jump in feet first.
Now, Andrew, following you were telling us to watch for the BRICs events on May 28th. Can you update us on the progress of this BRICs currency rollout?
Yes, Shane. One only has to observe the lack of reporting around Putin's recent visit to China, which underscores the panic hitting the globalist Davos crowd. Now, look, I just want to add that I'm not taking any sides here. I'm just assessing the implications as it relates to gold. Now, the fact is that the Sino-Russia BRICS alliance poses the single largest threat to undermine the multifaceted globalist agenda that relies on the unipolar status quo to be maintained so they can work their magic. Now, in my opinion, this is why we are evidencing such irrational desperation in trying to effect regime change in Russia. Now, the lack of wanting to discuss this or an end to the war, even to discuss it, even if it threatens an unthinkable World War III, cuts through the single constructed narrative. Now, while Putin's visit to Xi was on the mainstream media radar, it glossed over the fact that every key member of the Russian government, including generals, alongside the CEOs and bankers who represent literally trillions of dollars of liquid investment, tells us this unfactored move by the Sino-Russia hegemons has caught the Western hegemons napping. And it's clear that formidable game-changing alliances are being formalized and groundbreaking deals have been done and are being done. Now, if you recall, our contact who is involved with the organizing of many of these this year's BRICS events told us to watch out for announcements following the second meeting of the BRICS ministers of finance and central bank governors, which concluded in Moscow yesterday. We said to watch out for it. So far, we've only seen some limited reports from TASS and the BRICS statement, and we put a couple of links in that show the TASS and the BRICS statement that followed that meeting. And you can see things are hotting up, though. However, we also know that this is a precursor for the rollout of the gold-backed financial nuclear option, which is Glazev's 45% gold-backed currency, which has sufficient bullion already backing it to begin the process of formally rolling it out. And with sanctions ramping up around Ukraine and Taiwan, South Sea escalations, it's pretty hard to ignore. An announcement that the blockchain beta testing is complete is likely to be forthcoming. That's really going to set the cat amongst the pigeons. I hope it doesn't escalate a nuclear response. Now, when Glazev's gold-backed BRICS currency is formally launched, and it is realized that this beta-tested currency is far more liquid than was assumed because it ultimately backed by what liquidity providers assess as an aggregated 60,000 tons of gold, plus in the event of war, the PBOC has telegraphed they can equitably access around 25,000 tons of citizens' gold. And we dealt with how that was going to happen and how that was rolled out and how they were going to get that back and how they were going to reward citizens for doing that. But Western central banks will be forced to raise, as a result of this, the percentage of gold held versus the GDP to mitigate the upsurge of inflationary pressures of commodities paid for in dollars, forcing a global gold price revaluation event. There is little doubt about it. You cannot have this kind of disconnect going on. And the reason we bring this up now is the very bullish end of second quarter implications for the price of gold, which has started to get traction from a much higher stairstep led by silver. Gold is breaking out, so a fight has not been unexpected. The end of the quarter is only 20 single sessions from now. So this could present some opportunities to add some still grossly underpriced bullion. And there's going to be much more on this as it unfolds. But really, let me finish up by saying, look, what this is about, it's hopefully this episode, or these episodes really assist in providing a different wholesale market perspective to provide context against the short-term paper-centric chart chatter. So what's the point of looking at a chart if you don't know where those central bank levels are aggregated and the velocity of them versus what the paper market can generate? Really, this is all about coattailing the BRICS price makers. And as we take measures to protect our wealth by swapping out of dollars, euros, pounds, yens, yuan. As we always ask Robert Kiyosaki's question, how much physical gold and silver do you own?
Thank you so much, Andrew Maguire, for talking gold. And remember, to our Live from the Vault community, buy physical, make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button. It really helps us get out to more and more people and grow the channel. Also hit that share button there and share this information. And if you haven't already subscribed, you can do that too. Now, if you click on that black bell, we'll be notifying you as each episode goes live, so you gain access to this information in real time. So with that, we'll see you next time right here on Live from the Vault. See you then.